All right, let's jump into it. The big jobs report for Canada, a disappointing one, with the Canadian economy shedding more than 40,000 positions in July. Remember, June, there was a lot of excitement about a much better than expected employment read. Now, nobody was expecting June numbers, but on Bay Street, there was an expectation Canada would create 10,000 jobs in July. Instead, more than 40,000 were lost. We mentioned in our newscast, a lot of that was in youth-related jobs. Nevertheless, a lot of people are wondering what this means for interest rates. Already this morning, we have seen traders now fully pricing in a rate cut by the Bank of Canada by the end of the year. Obviously, they've already cut rates substantially, but they've been in wait-and-see mode in light of inflation worries and the trade uncertainty. Let's take another look at what's happening in the currency market. We mentioned the Canadian dollar weakening against the greenback on that news, again, because of that changing dynamic on interest rates. And then in the bond market, we saw the two-year yield come down as well. Earl Davis is head of fixed income and money markets at BMO Global Asset Management. Hello, Earl.
Good morning.
What do you make of this jobs report?
Definitely disappointing, but, and what that but is it needs confirmation. And what I mean by that, the headline number was disappointing, being down, but last month was up a lot. So the next employment number, we have to see if that trend continues in regards to the downward movement in jobs. So what I look at is the 3-month average of full-time employment. It's still positive, but barely so after today, 6.7. So if we get another negative number, what I believe is the market will discount eases starting in September, not by the end of the year. So the next unemployment number is very important to determine whether the Bank of Canada will ease or not on September 17th. And the reason why this is complicated for the Bank of Canada is wage growth went up. And the Bank of Canada looks at the inflation aspect of that as well, too. But if we see negative 3-month average of full-time employment, I think a cut is definitely on the table for the next meeting.
Okay, I want to get into something that is, it feels unique to Canada right now. You can correct me if I'm wrong here, which is you have a reasonably solid employment picture. Mm-hmm. Because like the unemployment rate held steady, where you have people who are gainfully employed right now, who are even feeling confident in that employment. Stats Canada said that when they were asking, almost 55% of employees say they are confident in their current line of work. So I would assume as part of that, they feel confident generally about sort of the status of their own job. But then there's a big part of the population that has really struggled to get into the jobs market. And you're seeing that in the trend as well. So we can point to losses in jobs, particularly in the youth market, but then you've got this other kind of big tanker of wait and see, wait and see. Someone has a job, hasn't lost it yet, but someone who wants to get into the employment, get a job, struggling to get into the market. I imagine that dynamic doesn't surprise you.
No, it doesn't surprise me because the individuals trying to get into the market are youth. So like if you look at the number, the highest unemployment rate is 14 to 25, basically. And that's always been a vicious cycle in regards to experience versus getting the job. And that's tough. And that's tough to reverse. And you need directed policies towards that. In regards to the other cohort, the confident cohort, as you said, the reason why that's extremely important is as long as people are confident and actually have a job, they pay the mortgage. You don't see default rates going lower. And this is why, or going higher, I should say. And this is why it's important to watch the 3-month average of full-time employment. Those are the ones who are in. And if that goes negative, the thing about the 3-month average going negative, it tends to be what they call sticky. It persists, it accelerates. And I think that's what the Bank of Canada would want to get ahead of if they see risks there. Okay,
let's talk about the Bank of Canada for a second. So the market response today was to say, well, looks more likely like they'll cut rates this year.
This year.
So the next meeting is September. But what I was saying, Bloomberg was tracking it this morning, is that there's like 100% confidence in the market right now, whatever that means, that we could see an additional rate cut this year. And so that was reflected a little bit in the bond market and the currency market. The inflation story, this came out when the Bank of Canada had its last interest rate decision where they didn't do anything. But it felt like Tiff Macklem was kind of shifting away from that, like, the sticky part of the inflation story that he'd sort of been bringing along for the ride, almost saying he didn't think that was going to hold over the long term. I felt like that kind of opened the door for them to cut rates. I mean, even as soon as, like if they were to cut rates in September, last interest rate decision, he said that inflation worry that he'd had was waning a bit. Is that fair?
Yeah, I would say the reason why it was waning is because we didn't see the inflation uptick from the tariffs as quickly as we thought we would be. Like people in January were saying inflation should be much higher by the time you hit August because of tariffs, but we're not seeing that. But also the narrative right now is that might just be delayed. So that's why the market is saying, okay, the cut is at the end of the year, not September, because the Bank of Canada wants more information.
Yeah.
The U.S. wants more information. I think an important element in this that we're not discussing as well was the weak employment number in the U.S. last week.
Yeah.
Which got
everybody thinking that you could see a cut in September, by the Fed.
Exactly. So I think that is an important trigger and catalyst for Bank of Canada cutting as well, too. Because 70% of our trade is with the U.S., and if they're having lower employment, that has a growth impulse that amplifies in Canada. So I think we also have to look at the U.S. numbers coming up. They have employment and CPI as well as we, another employment and CPI before the next meeting.
Okay, but you're not convinced we'll see the Bank of Canada cut in September?
I would say that's correct. I'm not convinced, but I do believe there's a higher probability that it could happen. We got two important data points, another employment number in both Canada and U.S. I think that is significant, as well as inflation prints that we have coming up as well.
Okay, and then just in terms of investment planning around this, looked like people were sort of locking in, buying a little bit of the 2-year fixed income today because, odds of rate cuts start to climb a little bit. How would you be positioning, if you've got fixed income in one's portfolio, how do you think about this?
I would actually feel comfortable going out to 5 years. I wouldn't go beyond buying 5-year bonds. And the reason why I feel confident there is the central banks have a lot of room to cut if things do turn around. And when the central banks cut, that directly impacts interest rates on longer duration product as well. I wouldn't go beyond 5 years in regards to an overweight because there's still a lot of uncertainty in regards to the inflation impact of tariffs, in regards to the amount of debt and deficits. That will impact the longer term of the curve, but I like fixed income, and I like corporate bonds above the inflation rate as well, too.
Okay, Earl, thanks a lot. Good to have you with us. Appreciate you helping us break it all down. Earl Davis joining us with his insight and analysis from BMO Global Asset Management.